Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a real estate investor, advisor, and coach, as well as the founder of Streamlined Properties and the team leader of Streamlined Properties on Market, brokered by eXp Realty. Whether you are looking to start from scratch, get to the next level, or just a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
The hits keep coming this week. On episode 33, it's Dave Meyer, the VP of Growth and Analytics at BiggerPockets. Do you know what BiggerPockets is? Really? I hope you do. It's just basically the biggest investor website out there where tons and tons of us have made lifelong friends, met other investors, networked throughout the state and countries. It's the place to be. And Dave Meyer is a big part of their content at BiggerPockets. You're going to like this episode, that I'm sure of. And if you have been liking the podcast as we go, Zen and the Art of Real Estate Investing, do me a favor, give us a 5-star review and write something about it. I'll go in and read those. I really appreciate that. And make sure that you follow and subscribe. And if you're on YouTube, you click the bell or whatever that little thing is. We just want people to make sure to get the information when you're ready. These come out every Wednesday morning. Stay tuned for Dave Meyer. This is episode 33 of Zen and the Art of Real Estate Investing with my guest, Dave Meyer, the VP of Growth and Analytics at BiggerPockets and a real estate investor. Dave, welcome to the show. It's great to have you.
Jonathan, thank you so much for having me. I appreciate it.
Yeah, let's go back. How did you get started at BiggerPockets? And then we'll get into your investing history as well.
Sure. I was investing for probably 5 years and had also been simultaneously working in the software industry and was looking to change jobs and thought, man, I really like real estate. I really like software. Why don't I look for a real estate software job? Googled it. I had never heard of BiggerPockets. And it turns out that the office was about a mile away from a triplex I was house hacking. I didn't know it was called house hacking at that time, but I was just invested on my own. And I was like, oh my God, this is amazing. So it took 9 months. It was a small company back then and took about 9 months before there was a job that I was qualified for, but applied, got it. And that was almost 7 years ago to the day.
Wow. Yeah. And so in the 5 years prior, what was your first investment? And then we'll get to how you got through to now.
My first investment was in Denver. I bought a fourplex with 3 other partners right in the middle of 2010. So the market was just about close to bottoming out. It was very cheap. I think anyone who knows the Denver market will be jealous to hear that I bought a fourplex in a very good neighborhood for $460,000.
Yeah, people just hung up on the podcast right then because they're mad.
Exactly. If only we knew, right?
Yeah.
But back then, I was like we were all worried about it. No one knew when it was going to bottom, what was going to happen. I knew it cash flowed, so I felt good about that, but could not have really predicted the appreciation we've seen in Denver and nationwide since then. But so that's how I got started. I was interested and learned a lot of hard lessons about being a property manager and a landlord over the years, but just loved it. I've always just really enjoyed it and found it really fun and engaging and rewarding. And I was hooked. And that was, I guess 13 years ago now.
Yeah, it's interesting though. The first investment, that was a straight investment between the 4 of you. Nobody house hacked it at all.
No, actually. So my roommate at the time and I were intending to house hack it, but then we realized we could rent it out for more than what we were paying in our rent. So we wound up just staying in our apartment for a while and renting it out because the cash flow worked out better.
Yeah. And were all 4 of you uniquely interested in real estate at the same time? Or for a couple of you, was it just more like money play and someone was going to figure it out?
It was a little bit of both. I really took on the active management role. I was waiting tables at the time and I had a lot of time on my hands. And I talk about this a lot in some of my other real estate writing, but I feel like for a lot of people getting started, you either need to have money or time. And I had no money. So I was willing to give up my time to get in on this deal. The other partners had money. So it was easier for them to just go and contribute. But I hustled my way into it a bit at the beginning.
Yeah, that's great for new investors because I think there is a subset of investing that's, oh, no money down. You can do it. You can get to 1 million units, but that's not generally realistic. But stating it how you did is really important. Money or time. And like time can be investing the resources like you have, data, anything, contractors, putting in the time to help somebody else to develop those relationships. It's interesting. Another thing that you said, though, you said you were house hacking. It's going to be, I'm sure, on another building, but before you knew it was a thing. And that's a very common trend, though, across like literally all of the recordings that we've had so far, is that investors were figuring out what it was before it became a term, which is really interesting. So when you initially intended to house hack, it was just to get the benefits of living in it and basically paying for it you'd live there for free.
Yeah, that was the original goal. It wound up happening with my second deal, which was only a block away from my first one, and took a few years, 3 or 4 years between them. But yeah, wound up house hacking that deal. And it was just like perfect for it. There's this one like small apartment, 2 big units. I could live close to and then manage the 7 units I was managing. They were all within a block of each other, which because I was working full time, I was also in grad school at the time. It made it like really convenient for me, which I think a lot of investors overlook how important it is to just try and make the decisions you make about your deals cooperate with your lifestyle.
Yeah. And a learning mechanism to be close enough. So if you really want to learn, if you don't go in intending to just be passive, which again, I don't agree that real estate investing is really passive at all. But if you really want to learn, like being close is there. Did you take in the idea? I've always fostered the idea of clustering for just investors themselves, investing within a couple block radius, but even for friends, like we have people who invest like in Philly near each other. You can just keep reboosting each other's value. Was that something you were thinking of at the time?
It was somewhat serendipitous. Like I was looking for deals and it happened. I would have taken one in one of several areas, but this definitely pushed it over like between a couple deals. This one made the most sense because again, super busy at that time in my life. And I wanted something that was close. And then I actually did it again in a different area in Denver. I bought a primary residence for myself and my girlfriend, and we were living there. And I bought another house for nearby just because I was like, I could do this. It's easy. I like walking down the street to fix stuff rather than getting in my car, sitting in traffic for 30 minutes each way.
Yeah, I think that people get a little bit too obsessed with, quote, the deal. So they end up going too much farther away when if you just paid a little more, you could like create your first year of managing the property be so much easier, like you're saying. But you're close. Totally. You can react to things quicker. You don't have to find someone in an area that you don't know. So that's interesting. I know some people complain about their markets, but you were doing this in Denver, which even in 2010 was still a hot market. It was just a lower hot market than before.
I'm a firm believer that one of the benefits, if not like the greatest benefit of real estate investing, is how flexible it is and how you can adjust your individual strategy based on the lifestyle that you want. And for some people, it's like, I need to maximize the best return and I'm willing to drive or hire a team in the suburb and manage all of them. That's never been me. I've always just been like, especially working full time, I was like, I just want to make this easy for myself. Did I give up a point in cash on cash return? Maybe. Do I regret it? Absolutely not. I feel like it allowed me to do other stuff I'm interested in my life. And so I think to your point, it's really just about like figuring out what you want and like trying to make it sustainable for yourself. Because if you make it sustainable, you could do it for longer. And as everyone who understands compound interest knows, like the longer you do it, the better. So it's really just about making it something that you enjoy. And I think that's often overlooked.
Yeah, great points of working it into your life also, because multiple investors have said this. I'm sure you'll agree. Sometimes people get into investing thinking that that's going to be the easy thing. And then they realize it's way harder than the 9 to 5 they had. You get 20 units and you're like, oh, they never stop calling. Yeah, exactly. I mean,
totally.
That's how it works.
Yeah. And if you're going to do that, you're running a business. And a lot of people, I think, get into it. You need to know how to run a business, which is not an easy thing to do. Like most people need experience managing people, managing contractors, managing tenants, communication, organization, keeping your books. Like there's a lot to it that is not just so easy. And I do think that there's a lot of media and pressure for people to like, oh, go quit your job or go do this full time. But I personally am a big fan of just like easing your way into it, learning a little bit at a time and not trying to get everything all at once. But again, just trying to make it sustainable for yourself. And to me, that involves growing at a responsible rate.
Yeah, that was really the philosophy behind how I started this podcast after listening to years of BiggerPockets and gaining so much knowledge and I've been investing for 30 years, but it's really about a mindful approach, which is what you're saying. It's more of a thought-based approach instead of doors acquire. Because sure, that can work for people who have an excess of money. Maybe it's not efficient money, but if you make a mistake on your first one and you use all your money, like you're not going to come back from that for a long time. And you have to be dedicated to get back into it. I just want to
totally agree. Yeah, I think like people, this is a whole other topic, but I'm writing a new book and I've been writing this chapter recently about risk. And I just think that's a really good point. Like people always want to chase the highest return and they hear, oh, you need a 12% cash on cash returns. I got to be honest, finding a 12% cash on cash return is difficult and you're going to have to take on risk to do that. That's not a good idea for your first deal. Go get a 7% cash on cash return and just enjoy the fact that you're learning, you're improving your financial position and like you're getting better every day. That to me, like that's the right way to go. Once you're really experienced, then you can start taking on a little bit more risk because you have a little bit more capital to play with. It wouldn't be a catastrophic loss if you take a hit on one particular deal. But yeah, I think I really like what you said about that.
Yeah, I would liken what you just said though to the current like issue with cap rate and mortgage rates, because it's like people will be emailing me and that's saying, "Oh, I'll only settle for a 9 cap," and I'm like, what world are you living in? Where does that doesn't exist anymore?
Yeah.
You know, and
call me in 5 years and
to.
let me know if you find one. I haven't seen one.
That's the buy box. I'm like, okay, I can just put that to the side and not worry about it, because anything that would be alleged as a 9 cap, I say, is like they're leaving out all of the actual data. It's not happening right now.
Yeah. And like real estate markets are efficient. So any deal that has exceptional return is going to have more risk. That's just how it works. Like any deal that's a 9 cap is a 9 cap for a reason. It's probably got a lot of deferred maintenance or it's in a neighborhood with low demand. There's all these other challenges. You don't just get into the game and all of a sudden get these deals that are far better than what experienced professionals are.
Exactly.
Not a reasonable expectation.
Yeah. And I think what you just said also applies to even the really small multi-game, because I think that people look at cash flow. They're so obsessed with cash flow because they want to make money. But your highest cash flowing properties most of the time have the most deferred maintenance. That's why they're high cash flowing, because they haven't completed the cycle. For novice investors, they look at it like, oh, look, I'm going to get 520 a month and it's great. Then you close and you need 2 furnaces and you're not making money for 3.5 years. And I think that's where, like you said, what you did and what you started to write when we were talking before gives a like wider approach on the data and how to approach it. What's your background in regard to data? And then how did you get into getting so deep on it on BiggerPockets?
I started, through a couple of different jobs, just regular jobs through the beginning of my career. I was exposed to analytics. I had a couple internships in college working for like a construction management company, a engineering company, and they just taught me how to use Excel. And I actually just really liked it. I know most people aren't that way, but I always just found it. Yeah, I just found it like really fun and fascinating that you could just build these models that would tell you and help you understand patterns. And so I always was doing something like that with my career. I worked in tech and actually started a tech company that was really focused. That did not work out, and went back and was working at a VC type fund, investing in tech companies. So that's pretty analytical. So I just kept getting into it. And I just wanted to get some training in something. And so I decided to go and get a master's degree in analytics. Like I knew what I was doing. I was like pretty good at it, but I just was like, I want to get really good at it. So I went back to school in Denver part-time, like I was still working, and got a master's degree in business analytics. And that it's like a half MBA, half data science degree, which was perfect for me because it's really all about how to make decisions with data, not just like the theory of it or being a great coder. I'm a terrible coder. And it really has helped me learn to just like understand patterns and figure out trends and make decisions based off of it. And that I've had many different roles at BiggerPockets, but that's always been one of the main themes. And then starting in 2020 in April, people were just freaking out, myself included. I was like, what is going on in the world? What's going to happen to rent? We're hearing these things about foreclosures, moratoriums and eviction moratoriums. So I just started like really digging into all this data that I knew existed and writing about it on BiggerPockets. And ever since, it's been really popular. Now it's scaled to blog. We've got multiple YouTube videos a week. We have our own podcast. There's 2 episodes a week. And I think fortunately found a need in the market for retail investors to understand data around investing a little bit better.
Yeah, you said something so important, that the analytical nature of what you're doing is to help people make decisions, you included. But I think that's so important because I remember when you started writing the longer form articles on BiggerPockets, and I was like, damn, we were talking about this before, but this is like the information that I want. And BiggerPockets is a conglomeration of a lot of new investors, but then a lot of seasoned investors like us who've been around for a while and really want a little high-end portal. And I think when you started doing that, it really helped everybody. Because I think like newbies can look at the data and really take something from it. And especially like personality wise, if you know the DISC test, if you're a high C, I just read all that. Like I love spreadsheets too. I just want to look at it and work the calculations and see it. But I think even for the other personality types, once they develop a trust level with the person doing the data analysis, they can just look at it quickly and say, okay, Boston's in the top 5. So let's just go to Boston.
Yeah, exactly. I think there is different personality types. Certain people take comfort or gain confidence to be an investor for having a mentor, for example. For me, I've like never even considered that. For me, I like trust numbers. I like numbers. And I'm like, if I got to trust my own analysis. And if I build out a spreadsheet and feel good about it, like I'm going to go for it. And I think there's just different types and both are useful. And I think everyone needs some level of analysis. But I found that for a lot of people, it does help them get over like the hump, especially beginners for the early hump, just like understanding that it's not gambling. Like there are predictable returns, there are predictable outcomes. Despite recent evidence, over the long run, housing is relatively stable, predictable asset class. So I think that's really helpful for people. And then as you become more advanced, you're constantly trying to evaluate how to reallocate your capital, how to balance your portfolio. And the best way to do that is just by having a firm understanding of what your options are and what's happening. And that allows you to build a strong portfolio over time.
Yeah, I'd love to get your take on this too, because I love the analytical side myself, but I do feel for newer investors, the analytical side is what can create the analysis paralysis because that's all they do. So I've always said that it's great to use, if you're good at analytics, but you have to get out in the field and see it. And then once you start seeing stuff, those spreadsheets that you have become so much more valuable because you're taking the data and attaching it to real life. And then you know what $250,000 smells like in your area. It may not smell well. It's not going to smell good in some areas, but 250 somewhere else could be super high end. So do you agree with that? That like what we do as like kind of data nerds is so important. But I think like newbies, they say, I've looked at 40 deals this week, and you ask them how many they saw and they say 0. And you're not really going to know anything until you see them in person.
Totally. I think you have to add that contextual nature to it. When I first got started in real estate, it was the bottom of the market following the recession. And as you probably remember, everything was on the market. There's so much inventory.
Including a couple of my houses in Florida.
Sorry to hear that. It was this thing where I didn't have a lot of money. I waited years between investments, but I would you walk by an open house. I'd go into them all the time. I've been in probably hundreds and hundreds of open houses that I had never had an intention of buying. You just get a sense, talk to the agent, like doing that stuff. You get a real sense for what things cost, how popular it is. You even overhear what other people like about the house, what they don't like about the house. And I think it's been hard for investors the last 2 years through the pandemic. One, because at first, like showings were all weird because of the regulations. But then, in other words, they weren't even doing open houses because there's so much demand. The selling agent didn't even need to do it. I think now we're entering a time when the agents are going to have to be more accommodating to buyers. And I highly recommend to people just go stop in a house. I just did it today. I live in Amsterdam. I'm a renter. I have no intention of buying, but there was an open house. I was just curious. So I just went into it just because I like looking at houses. So I just really encourage people to do that, because then it gives you that frame of reference. Like you said, this is what it costs. You will be able to identify like, oh, I've been in 20 houses that cost 400 grand. This one has the same price, but it's a perfect layout for a rental. Like that's when you're like, okay, now I know this is better than everything else out there. And this is the one I'm going to pursue.
Yeah, I love that follow-up. It's perfect. And I think sometimes people say to me like, oh, you've been in it so long, so you just more. But I grew up with my dad investing. So I was like going to dump foreclosures like every weekend from the time I was 5 on. So I had like inherent knowledge that I didn't know I had. So then when I started investing at about a little bit more than 18 on my own, I just knew stuff that I didn't know. And like you're saying, if you see an open house, why not go? Because the more reps you get, the better you're going to be at identifying stuff. I love the point you made. You can overhear things that other people say that may help you when you're brand new. So, actually, that's a good point from a consumer perspective, especially if you want to be a flipper. You want to know what people are saying about what's in and what's out, what works and what doesn't, because I'll get your opinions on flipping. But like, I find it to be really tough now because I think that people aren't doing it the right way because they're just looking at the numbers, and like you're flipping for someone who wants to buy the house. So it's not just a numbers game.
Absolutely. Yeah. I just think it's good to have a good relationship with your agent, or just go look for open houses. This is a business. People want to shortcut it a lot of the time, but just learn everything you can. It's not that complicated. If you can really expose yourself to the day-to-day operations, what houses look like, what they're trading for, and learn the analytical side, you're 90% of the way there. It's a lot of the business.
Yeah. I know you're digging into data all the time. So I want to get some of your impressions on what we're looking for in 2023 in terms of like markets. Do you have some like top markets or low markets based on data that you're looking at? I know you're going to put out a lot of articles on these. I don't want to get any spoilers, but like this is what
there's nothing to spoil.
People love.
I would say that there's the rule of thumb is that the hotter it was during the pandemic, the further it's probably going to fall in 2023.
Yeah.
This is just a function, and so much of the housing market in this year is a function of affordability. It's just too expensive. People can't afford it. And I know people are saying like, oh, it's been going up for years, but the insanely low mortgage rates of 2020, 2021, and half of 2022 masked the increasing prices. It was still affordable. There are all these measurements of affordability. And like, even through the end of 2021, houses were still affordable, even though they were appreciating at 20% per year.
Yeah.
Now that has completely changed. We're at a 40-year low for affordability. Mortgage rates are so important, and our housing is so interest rate sensitive that it's just a natural thing that these markets that overheated are going to come back down.
Yeah.
But I think there are lots of markets that are going to stay relatively flat. They might come down 1 or 2%. I don't know. But just relatively speaking, a lot of them are in the Midwest. Cities like Chicago, Boston, Philadelphia are holding up pretty strong right now. There's cities like Tampa or Raleigh, some of these huge, those were hot markets in the pandemic, but they are attracting so much population growth and so many businesses are moving there that they are shrugging that off. I guess on the low side, Austin is and Boise are seem to be like the
Salt
poster
Lake,
children.
Right?
Salt Lake, Reno. I keep picking
Phoenix.
on.
Phoenix is just a product. So you can just look what happened with Zillow and Open Door there and know there's a problem.
Yeah, it's interesting. Like a city like Phoenix surprises me that it went up so much because like there's population growth, but it's not like, Austin, where every other day there's a major tech company relocating their office for Austin. It's like, I could understand why people think the market in Austin or Tampa is like attracting a ton of business. Those types of markets, I'm like, okay, I can get by that. But I'm like, Reno, really?
I know. but I think it's a product of news and real estate news sectors like that focus on it. It's why what you do is so important, because I think it boils down and takes away the headlines. Headlines these days are just generally clickbait. We don't know that they're true. Data is true. I wanted to get your opinion on something, though. We were just talking about a couple minutes ago. I think one thing that people miss in the whole like data breakdown of affordability is the fact that what you were saying, like people bought with such low interest rates and now we have a lack of inventory and they're like, oh, no one wants to sell. No, lots of people want to sell. They just don't want to sell out their 2.95% mortgage for a 6% mortgage on a new house. So they're kind of, I think, a subset of sellers who are just like, it needs to get better. Like our mortgage rate is too good. Are we growing out of this house? Sure. But that's why so many people started doing additions, because it's a better spend for them. So they don't have to leave their house. Do you think that's a factor in the low inventory? That's what I've been thinking about.
100%. Absolutely. I think we're only beginning to see the consequences of this. I have no idea. This could be with us for years. Imagine if mortgage rates stay above 5%, which there's probably a good chance they stay above 5% for a few years. Who's going to sell? There's all these analyses that I've looked at where it's basically if you were to sell your house and buy a similar house, you would be paying significantly more just to go laterally, to have a similar size house. To move up a bedroom, you're going to be like doubling your mortgage payment. To your point, it is way more cost effective to do an addition, or some people, it seems like, and I don't have hard data on this, there's a lot of anecdotal evidence on this, that people are just going to rent them out. Because if they have that low interest rate, rents have exploded over the last couple of years. They're just going to become landlords, and then they're going to buy a new house. Maybe they'll be paying more from it, but then maybe the rental income from their first house will offset that increased cost.
Yeah.
I think unless interest rates go back down to 3 or 4% at some point, this is going to be with us for quite a while. And frankly, I don't think we're ever seeing 3% interest rates again. If they get into the 4s, maybe. But I would expect, personally, I expect mortgage rates to live much closer to their historical average over the next 5 years than they have over the last 2 or 3 years.
Yeah, there's a couple of things baked into that. One thing about what you were saying, I think it's even hard to downsize now. I still think that's a good play because I think there's such limited inventory that it is a good time to be a seller, because whatever buyers are out there, there's just nothing to look at. So you can put stuff on the market. It's like where I am in New Jersey, we're all back multiple offers. Last week we had 18 offers, 23 offers. Like it's not stopped there, but there's no inventory. And because we're so close to the city, like the opportunities are still there for it. But downsizing is not even that easy. Like we were talking about upsizing and like mid-sizing. But if you sell out and then you have to pay up, you're going to be like at a break even to downsize. And it doesn't,
why would
it
you
doesn't
do
make
that?
sense. Yeah.
And that creates all sorts of other issues, right? Because like then this normal cycle where older folks who maybe empty nesters, for example, downsize, that frees up those more family-centric homes. We're not building a lot of family-centric homes in the United States. So now more of them are going to be occupied by older folks who don't necessarily need the space, but are making an economic decision to stay in it. And that's going to have implications for prices on housing on the lower tier, starter home kind of categories. So I think it's something no one understands because we've never had something like this yet. But I do think it will have pretty big implications on inventory and the housing market dynamics, at least for the next 2 or 3 years and maybe even further.
Yeah. And I think you mentioned something really important that I don't want the listeners to miss, but your regular single home owner who needs to go out and maybe has a little extra money might consider what you said, renting out your primary residence before you thought, not thinking you were going to be an investor. Remember, a lot of people, the rates are too high for them to qualify for the type of house they want. They may be happier to pay up and rent. It's why rents are up so high. So the single family rental, which is what I've pretty much invested in my whole life, not multis, it's just single families, is very attractive right now, I think, as an owner, because you're going to get a good amount of inventory. People can then be in a single family house and feel like they're on the way to home ownership, but not ready to buy it. Eventually, those could be actually your buyers. We sold one of our Airbnbs a while ago to one of the tenants who came because over time they just adjust to it. But do you feel like that's going to be a way where regular homeowners might turn investor if they can just understand that this is just a better move than selling at a loss into a higher rate?
I do. I think that is going to happen. And I'm not sure it's a good thing for the housing market in general, but I do think there is a good chance that will happen. I personally believe that the lack of inventory and the lack of, like velocity of changing hands of the market is going to be a problem for the US just in general. Like we're already seeing renters are rent burdened. Things are becoming less and less affordable. And that's just not sustainable. I don't know. I'm not saying it's going to break and blow up right now. If we just see more people hanging on to their homes, not trading out, it removes some of this like natural market activity that happens in a capitalist system that needs to happen for it to like function properly.
Yeah.
And I don't know if I'm just extrapolating here, but I do think like there is a lot of risk based on this like lock-in effect that if people just don't sell their houses and inventory stays as low as it is right now and it's bottomed out. Like people were all saying the market's going to crash, inventory is exploding. No, it's not. It's leveled off. It's declined. We're recording this in the beginning of February. It's declined the last 3 weeks.
Yeah.
So I think they're just like, we don't know what's going to happen. But if this continues where there's just no inventory on the market, I think it's going to have like pretty significant implications for the market that we don't really understand yet.
Yeah. Something I thought of while you were talking about another point is I feel like the people who are buying occupied multis may be in more jeopardy than they think because why would those people move? If you're in a tenant friendly state like I am in New Jersey and you buy into a multi expecting to evict someone, get the rents up, they can't really move because if they're paying $1,000 and market rent's $1,500, where are they going to go? So they're going to fight tooth and nail, and they have the law on their side in a tenant friendly state to stay. So I think that's where like investor friendly agents are really important. I train my whole team to identify that, listen, you can't get these people out unless they get out. Cash for keys doesn't work. I think it's something to watch for small multis when they're low, which again used to be a good play because long-term you can get them up, but like there's nowhere to go for them now. You can't get a good rental for the same price that they're paying.
No, that's definitely a very serious consideration too. It'll be really interesting to see. Yeah, like the rents went up super high and rents tend to be stickier too. So It's like we're seeing the housing market start to decline a bit. That could help restore some affordability. But rent, it goes down, but not that much. Like during the Great Recession, just relatively speaking, I think like peak to trough rent went down like something like 6%. National housing market was more like 20%. So that's 3x the decline in housing prices versus rent. And personally, I do think we might see rent go down 1 or 2%, but the data, at least right now, does not suggest it's going to go down. So I think it's going to, like people are probably going to move less in rentals and in homes too, which will obviously have even more implications for the market.
Yeah. Today's episode of Zen and the Art of Real Estate Investing is actually brought to you by another podcast. It's called The Art of Agency, a launchpad for realtors. It's hosted by me, Jonathan Green, and Mallory Pazder, and it's coming at you soon. It's available now, the trailer edition, with more episodes dropping soon. So check it out everywhere you listen to podcasts. Wanted to get your opinion on this because I know you've been obviously doing research on the large scale multifamily too, but do you think there's going to be an issue with all the syndications out there with the adjustment in cap rates to the terms that are out there? I feel like syndications that are not well vetted or not well funded the right way, they could be in big trouble this year.
Oh, yeah. I think on BiggerPockets, we've been trying to talk about that more and more the last couple of weeks. I actually think today I have a YouTube video coming out that's talking about how commercial real estate is valued through cap rates. You understand this, but I think a lot of people don't understand that cap rates moving from 5 to 6% means a 20% reduction in value of asset prices. So it's like people are like, oh, cap rates went up a little bit. It's like, yeah, and the price tanked. So I do think there is very considerable upward pressure on cap rates. And I follow this data really closely and they haven't moved up that much.
Yeah.
And it just feels like, I don't know if you know Brian Burke, who
I literally just moved his book from one room to the other. It's like right behind me.
Oh, really?
Yeah.
He's great. He's one of the best commercial real estate minds out there. And I was talking to him about it and he was just saying for the last couple months, there's like just enough people who are still like coming off a 1031 and are willing to pay a low cap rate or foreign money or something, like had all this money, liquidity from the explosion of asset prices over the last few years. But to me, they have to go up. I just don't see how we can live in a world where cap rates are lower than interest rates. That's dilutive to the performance of the property. And so a normal spread between cap rates and interest rates is about 150 basis points. So we're inverted on that. We're underwater on that. And I don't think necessarily cap rates will go up 150 basis points, but they could. And if that is true on a national basis, that would mean a 30% decline in asset values.
Yeah.
And so I have said a lot, and I stand by that. I don't believe residential real estate is going to be in a crash situation. I think somewhere under 10% in 2023 is the most likely scenario on a national basis. I could see 15 to 20% declines in commercial in the coming year. And that said, I'm still investing in them, but they have to be very good deals. And I really think value add is the way to go right now, because if you can find something that's super, a lot of deferred maintenance, and you have a good team who can actually add value and actually increase NOI to offset rising cap rates, like that is still a feasible business model.
Yeah, and I feel like during the pandemic, there's still a glut of commercial properties available, which can't really be judged by cap rate because they're vacant. So there's no way for someone to lend on it. So those are cash buys, and those are sitting there as like these structural anomalies that we can't evaluate because there's just the companies like Toys R Us or Macy's. Those are like huge commercial blocks with just buildings everywhere that could be repurposed, but it's not as easy to buy because you can't get a commercial mortgage on it. There's no tenancies.
Yeah.
So I think like we can talk about cap rate, but there's still like all these buildings that don't apply that at some hopefully will apply again because it's wasted space. Do people want to turn those into apartments? That's especially based on what we're talking about. More affordable housing would be nice, but who wants to do it? That's the issue.
Yeah. I talked to someone, I can't remember who it was. Oh, it's I host a podcast called On the Market, and we had Ben Miller, who's the CEO of Fundrise on.
Yeah.
And he was talking about, they did this analysis, and it's something like only 1 out of 8 office buildings would make a good conversion, just from like layout, zoning. Yeah. There's all these different things. Parking consideration, like all these cities have all these rules. It's so hard to know. So maybe in an effort to improve affordable housing, cities will accommodate them and work with investors. But right now, it's not the easiest thing to do.
It's the plumbing adjustment on that, I think, is the biggest thing because your office buildings have limited bathrooms and then you have to change. You want to do 40 office bays into 40 units. You need 40 new plumbing for each, so each unit can have its own.
Unless everyone wants to share a bathroom, you can do like modified college style. Yeah.
Yeah. So tell us a little bit about your podcast. I know sometimes you hop on and co-host the BiggerPockets, the regular original podcast, but you guys have so many other podcasts. Which is yours? And do you have a co-host on that one?
I host one called On the Market. It comes out Mondays and Fridays. And I don't have a co-host. I am the host, but we have a panel of experts who come on. Not every show, but probably 70% of shows feature. We have a really good, well-rounded group: Kathy Fettke, James Daynard, Henry Washington, and Jamel Damji. So it's like this group of people from across the real estate spectrum. And our whole angle is just talking about market conditions. And so we discuss economic news, data, information. And I think the cool thing about it is that with all the panelists, they have really broad experience and can tell you like day to day, these people are doing 20 deals a month. So they really know what's like happening in the industry. And so we have good conversation about it. And again, just trying to help people make good decisions based on as much current information as possible.
Yeah, awesome. And the book you're writing now, what's that? And what other books have you done? Because I know you're always writing. What's out there and what's coming?
So my first book came out in October. I wrote it with Jay Scott. I don't know if you know Jay.
Yeah, I'm just waiting. Jay, I'm waiting for you to fill out your form, so to get him on here.
He's a busy dude.
I know.
He's a very busy guy, but a very smart man and great investor and great guy. And he and I wrote a book called Real Estate by the Numbers. It's all about deal analysis. And I think if you're one of those folks who struggles with analysis paralysis, this is a book for you. It's all about how to underwrite deals and analyze deals in a really effective way so that you like really know what deals are good. You can speak the language, understand the different metrics, that kind of stuff. I'm writing a book now. It's similar to about what we were talking about at the beginning of the podcast, which is just about figuring out a way to make real estate fit your specific lifestyle and goals. It's really about portfolio strategy and like adapting your portfolio to the things you want. I'm sure, Jonathan, you get this question all the time. People are like, should I flip houses or buy rentals? I'm like, what do you want in life? Like, those are two totally different things. Do you want to run a high stress, super hard business like flipping? You get great returns, but it's risky. It's time consuming. You want to be boring and buy rentals like me? It's totally different
Right.
business. So I think there's a lot of frameworks, and the goal of the book is to help people think through some of the like critical trade-offs you need to think through. There's no right or wrong answer in real estate, right? It's like there's just trade-offs. Like some things are riskier, some things are less risky. Some things give you passive more. I agree, there's no passive income. Some things are more passive.
Yeah.
Some things are less passive. You have to just think about what you want and then like back into a real estate strategy. And so that's what the new book's about, but it's not coming out for another 9 months or so.
Yeah, but that's awesome because that is a mindful approach. And I think that's like investor culture just on the large scale with all the kind of like things that are being sprayed at new investors. Everything is just like, do it, do it, do it. But that's how people lose their money. Like you just don't do it. You shouldn't have been flipping in the last 2 years because you're buying in high. All the costs are high. Lumber just went up again. So when people say, hey, I'm thinking of doing a flip, I'm like, why? I only do one at a time. And although I love it, I hate it every day because there's always another cost that comes. And we know our numbers to the T, so we're not going to lose. We're still going to make a lot of money. But this is a really tough time to just throw it out there and say, hey, I want to flip. I think they do need to sit back and, like you said, identify like, what do I want to do with my life? Where does investing fit in? You can't, I'm going to self-manage a 20 unit apartment building, but I don't like people. Like, okay,
yeah, exactly.
Like you're going to be a slumlord. That it doesn't work like that. Yeah, that's awesome. And
totally. Yeah. I think there's a big part of the book that just like helps you identify like the skills that are needed for different strategies and whether they're good for you. Like for me personally, I've figured out that I love now investing in syndications because it's very analytical for me.
Yeah.
Figure out, is this a good market? Is this a good business plan? Do I buy into it? Is it a good operator? I can do the analytical part of this. I don't mind being a property manager. I'm not drawn to it. It's not my calling in life.
Yeah.
And so I stick to the things I'm good at and build a portfolio that leverages my skill and my goals. And it's working out great. And I think people should take that approach. And we were joking at the beginning, but this idea that you need to rack up doors, I think is ridiculous. It's like, you just need to figure out what you want. And there's plenty of real estate strategies that can support really almost any financial goal. So just start there.
Yeah. Yeah, it's funny. I've said this a lot on this podcast, but I'll say it to you as well. I think doors is like the most confusing thing in the real estate investing world because if you don't own 100% of a door, it's not really a door. So yeah, if you own 1% of an 100 unit apartment building, you have one door, not 100 doors.
Exactly. And I see, God, it drives me nuts to see these people are like, I have 10,000 rental properties.
Like,
no,
wait,
you don't.
You're 19 and a half.
You don't. Yeah. You're lying.
Yeah.
It's like, I literally have no idea how many doors I have because now I invest primarily in syndications. I can't even tell you how many doors I'm a partial owner in.
Yeah.
I might be off by 300 units. I have no idea because it doesn't matter. Like to me, it's like, how much cash flow do I have? What's the equity value of my portfolio, and what level of risk do I feel like my cash is at right now? So I don't know. That's a topic for another time. But I think we see it similarly.
Yeah. You said something important about syndications. I think when you're in the business and real estate, operator is really important in the syndication because you can look at the data, and if the data looks good, you're like, this is a go. But if you don't know the operator, you don't have the trust value that you need. I've been saying on other podcasts, because we've had a lot of syndication conversations recently, that like syndication marketing can be so good, but that can be a problem, which is what we're going to see for the rest of the year. You got marketed into a funnel that's not a solid syndication, or that's requiring the LPs to do more than expected. And I do think there's going to be some issues this year. And that's something, like you're saying, you look at the operator, you look at the data, you have a trust level. Like that's as passive as you can get as an LP, but it's fun passive to me because you can look at and feel a part of it when the information is delivered the right way from the syndicator.
Absolutely. And I think, the reason I like Brian's book, and I also have Brian's book right here. I grabbed it while we're talking.
It's literally right behind me.
I love it. It's a great book. And I think people look at like the highest IRR or the highest rate of return. And like, I used to think that way too at first. And now I'm like, this person's just wrong. Like that's a sign that they're overly optimistic to me. Like the syndications I wind up doing, it's people who are usually underselling the IR. And they're like, I'm going to give you 13 or 14. And in the back of my head, I'm like, they're sandbagging this and they're hoping to give us 17, but they're not going to say that because they don't want to disappoint their investors.
Yeah.
That's the kind of people I want to invest in. I don't want someone who's like, I'm going to give you 18, but everything has to go right. Yeah, exactly. So it comes with maturity. And I think like a lot of media and personalities in real estate, multifamily, everyone wants to be a syndicator now. That's hard. It is not an easy business. And I think if you're going to do that, start with small multifamilies, learn before you start taking other people's money. Because as Brian has said, you do one syndication that goes wrong at the beginning of your career, that's the end of your career.
For sure.
Think about it hard.
And I think that's the investing world is much smaller than people think. If I don't know someone, I know of them and I can get to them in a one-person, one-off, and they will find out, and those things will go south fast. Before we hop off, I wanted to get your last opinion on this. Like our term for 2023 at Zen and the Art of Real Estate Investing, which is also our meetup group as well, is asset hunting. And the way that I put this to people is all the data and stuff, like we said before, is so important. Like you have to have it. You have to go in and get the knowledge. But like in my head, when I'm investing, and I think what I learned growing up is I just want things that I can look at and think that's a good asset. If the numbers don't make like a certain calculation, I don't really care. I'm really betting on myself in terms of buying markets or like a type of building, because the data doesn't always really show you what's going to be. So do you advocate that as somebody who's like really into data? You still have to have the eye that you develop.
Totally. Look at what Zillow and Opendoor
exactly.
They tried to rely 100% on data and they failed miserably. The inherent nature of data is it's backward looking, and there's patterns that you can look at and you can learn from. And I think there's great things you can learn from real estate data. Real estate is really lucky. There's a lot of data. You can learn rent growth trends, appreciation trends. Can't tell you what's going to happen in the future. And so there is some element of learning from the past, but also being in tune with your market, being in tune with macroeconomic conditions, and having an intuition for it that grows from being experienced. And I totally agree. I think this is the kind of time where the data might tell you not to buy right now. But every experienced investor I know is buying right now. Every single one.
Yeah. For the national news makes it doom and gloom. I'm literally I sold a bunch of stuff during the pandemic to stockpile the gunpowder. And now I'm like, when everybody starts freaking out, that's when I go.
Exactly. Right. Yeah. And so I think this is a time to be logical. We talked a little bit about my first deal. I didn't know if it was going to appreciate, but I was like, this is a really cool house. It's 4 units in a really great neighborhood in Denver. I'm pretty sure I could get it to cash flow, and I bought it. I took a risk. It's a calculated risk, but it worked out. There are different conditions now than were then, but I think the mentality is the same. It's like, if you can, if you are humble enough to learn and not focus on like maximizing everything and going from 0 to 100 immediately, and you're willing to just be logical and look for base hits and to get started, I think now is a great time to get started, to be honest.
Yeah, I agree. This has been fantastic. If people want to get in touch with you, should they do it through BiggerPockets?
Sure. Yeah. I'm always on BiggerPockets. I'm also pretty active on Instagram, where I'm at the Data Deli.
Yeah, I didn't want to miss that. If you're not following the Data Deli, you need to follow it. Dave is piling on the videos each day, which are really, I feel like I really enjoy them because it's like a quick burst of like market knowledge to start the day, or like an aha, and then you can go deep dive and do more research around it. But have you gotten a lot of value from being able to give people an overview that's not slanted towards any side? It's just data based, which makes you sit in the middle, and it can have anybody can react to it.
Totally. Yeah. My whole goal, whether it's on the podcast or on Instagram, is to just provide objective data. I think you're alluding to it, just a truth these days that like every media source is slanted one way or another, and both sides do it. It's just,
I don't look at the news at all. None.
Yeah. So I just try and look at data. My goal is always to look for source data. So if I read an article, I click through the link till I find who actually published the information and I read it. and then I report on it. I don't just read the headline and reiterate it. So I try and do that, encourage other people to do it. But yeah, it's fun. I was hesitant to get on social media. I was never like a social media person. And then I started writing and hosting podcasts, and people were like, you have to get an Instagram. And so I did it, but it's fun. You really meet interesting people. You learn a lot. There are always those like crazy people who make crazy comments, but for the vast majority of people, ask really good questions or have thoughtful responses. And it's a really cool medium. I've really enjoyed it.
Yeah. All right. Last question for you, Dave, before I let you go, from Amsterdam, which is just awesome in and of itself. But if you could give new investors one piece of advice to be more mindful outside of what we talked about or following up on something that we did, what would you tell them now in today's market conditions going forward?
That you need to be able to sleep at night. I think this is a really important part of investing. I just read a book called The Psychology of Money. I don't know if you've ever read it by Morgan Housel. It's great. It's like beginners, but just like really good, just anecdotal stories about how to think about money. And I think like, to me, the element of risk and reward is like this under talked about. I keep hitting on it today because it's just something I think about a lot, is this under discussed part of real estate investing. And I think if you don't get it, people are like, I can't get a 10% cash on cash return. If you're more comfortable with a 6% cash on cash return because it's a safe deal that you know is going to get paid every single month, go do that. Yeah. For me, I'm not a particularly risk tolerant investor. I'm pretty conservative. Like for me, I know that I'll take a little bit less of a cash on cash return because I buy in places that I know are in high demand. I'm always going to be able to find good quality tenants, and I can sleep at night. And I think that's, to me, something that people really just need to think about, that investing is meant to support your lifestyle, not the other way around. You shouldn't be like living to service your investments.
Amazing. Fits perfectly into the mindful approach to real estate investing.
I love it. Yeah, I love it.
Dave, it was an absolute pleasure to meet you. Now I'm excited to stay in touch. This was a great conversation. I look forward to having more. If you want to find Dave, you can go to BiggerPockets and just put in Dave Meyer. You'll find him. Just look for the guy who lives in Amsterdam, make everybody jealous.
Exactly.
Yeah, and if somehow you're like, don't know what BiggerPockets is, please go to BiggerPockets.com. It's where hundreds and thousands of us have just made lifelong friends and connected with investors all over the country and learned a ton of information. They have numerous podcasts, one which Dave told you about, which he hosts, but there's many more. And I really think it's like the portal for investors to learn and to grow. And now with Dave's data out there, you can get the super high-end data as well to mix with all the fun in the forums.
Thank you.
Yeah. All right, Dave. Pleasure to meet you, and I look forward to staying in touch. This has been episode 33 of Zen and the Art of Real Estate Investing with the VP and Growth and Analytics at BiggerPockets, Dave Meyer. We'll see you next week. Thanks, Dave.
Thank you.
I hope you enjoyed that episode of Zen and the Art of Real Estate Investing with me, Jonathan Green. And I just want to remind you, and this is always an uncomfortable part, I don't want you to think that I'm begging for you to like, subscribe, follow, do whatever you have to do for the podcast, leave a 5-star review. But if you like the podcast and you think it adds value in the real estate investing sphere, then just do me a personal favor. Like the podcast, follow it, share it when you can with your friends, and be so kind as to write a 5-star review if you believe it deserves a 5-star review up against what else is out there. I would really appreciate it, and I hope you keep listening.